Hi everyone, and welcome to today's AJ Bell Invest Centre Off the Road webinar. Today I'm going to be looking at all things state pension. For those who haven't joined us before, my name is Charlene Young. I am Senior Technical Consultant here at AJ Bell. I'm really pleased to put this another edition of Off the Road on for you. As we go along, if you'd like to ask some questions, please feel free to pop those in the chat box. I believe it's in the right-hand corner for you guys. Likewise, at the end of today, you will receive a request for a feedback form, and there's plenty of room there online to put your questions, feedback, suggestions for future webinars in there, which we're very pleased to hear. Please do ask away and we will do our best to answer you. So it should be about 50 minutes today, depending on how long I waffle on for. So let's get kicked off. So state pension. It's not something we've generally covered too much, particularly in our off-the-road sessions, hence doing it today. And when I was thinking about this session, I thought it was quite strange in a way, actually, because once you think about it and look into it, the state pension was actually paid to 12.4 million people year to date, February, according to the DWP. So it really obviously affects all of us as individuals. It will affect you guys dealing with clients who are coming up to state pension age, who probably already claim, or actually in your future cash flows when you're thinking about how to factor it in, how to discuss it with clients. And we'll think about that at the end of today's session in some discussion points about how sometimes it's easy to kind of forget about or undervalue, what state pension somebody might receive later in life. So in terms of what I want to cover today, looks like quite a few points when it's on that list, but do bear with me, it's about 50 minutes today. So what I want to first talk about is kind of evolution of state pension. So where have we come from, basically? Then we're going to look at currently what the state pension age is and what changes might be coming down the line for that. Then we'll look at the new state pension regime itself, so where we are today. But also with any kind of new regime that's been introduced, there will be some transitional issues, and we will cover them, kind of what happens to the group of people who had probably built up benefits or entitlements under old systems when we move to something new. Then I want to cover the triple lock, feels very topical at the moment. And then I want to look at state pension forecasts, what they look like, things to watch out for. Finally finishing in terms of sort of content on missing or gap years. There'll be a last kind of word on deferrals and maybe something to think about in terms of your clients, whether deferral might be a good option for them. But that kind of gives us a good idea of what we're going to look at today. So in terms of the kind of evolution of state pensions, where have we come from? So the best way I can kind of think about it is that the main objective of the UK state pension system is to reduce poverty at old age, and that's designed in a way that provides a flat rate pension benefit with the aim of reducing people's reliance on means-tested benefits. So I think the key word here is the word benefit, and that is sometimes quite easily forgotten when we hear commentary about state pension, when people are talking about it. So it sometimes might be easier to think of it, or particularly for framing it with clients, talking about it as a benefit. Obviously, your clients have you to rely on, you and your teams, people without advisors. There is this kind of misconception sometimes around the word benefit and how it fits into state pension. And I think to understand kind of where we are today, it helps to look at where we've come from in terms of what was previously available. So kind of first on my timeline here, we have gone all the way back to 1908 and the Old Age Pension. So in that same year, the Old Age Pension Act was introduced, and this brought with it a means-tested but non-contributory payment. So it's kind of hard to find many details on it, but it was sparked. I'm sure I read somewhere, possibly on Twitter, so maybe not the most reliable of sources, that this was paid to upstanding individuals only, so like certain members of the community that whoever decided at the time felt that these people were sort of worth or worthy of receiving this state or this very first kind of iteration, if you like, of an old age pension benefit. Either way, whatever it was, it certainly wasn't a safety net for the most vulnerable. And then in terms of between those first 2 points, actually, there's another kind of time point that I wanted to talk about, and that was 1925. So then there was a scheme introduced for kind of low wage and manual workers. So that's actually starting to look at helping some targeted groups of people. But again, neither of these kind of first two very early iterations were anywhere near sort of universal in their coverage. And that's important because in 1942, we saw a report, the Beveridge report, and that called for such a universal coverage system, again, based on the model of social insurance, with the objective of providing a safety net in old age for people. So kind of coming back to that original objective that we sort of know so well today. The proposal from Beveridge was actually for a fully funded flat rate scheme. But what emerged years later, as you'll see on the timeline in 1948, was of course at the mercy of sort of politics. And think about the wider circumstances at the time. The report was out before the end of World War II, and the proposal in its purest form, however kind of brilliant the proposal was and however many people it would have helped, it would have had tremendously high costs, particularly as that system would have needed, by design, to start paying a basic state pension straight away to those people who had made no contributions. So what we got in 1948 via the National Insurance Act of 1946 was the basic state pension. And that was obviously with us, as you can see through that timeline, until the new regime in 2016. So yes, from 1948. And that basic state pension was a pay-as-you-go system, okay, rather than a fully funded one that the Beveridge had perhaps hoped for. And as I say, we still kind of see misconceptions today about how people have funded their state pension, they're owed money, when in fact the system is a flat rate benefit, as we kind of went through earlier on this slide. So individuals pay national insurance contributions, but the level of contribution to the benefit system is actually what is needed, or what was needed to fund the benefits of current pensioners, okay? So rather than paying a contribution to kind of your own pot, if you like, as we know well in terms of private pension provision perhaps, the pay-as-you-go system means that, you know, today's workers, today's contributors are paying today's pensions. Okay, so back to our timeline, and in 1961, the first add-on to the basic state pension was introduced. So the basic state pension obviously carried on, but we had this extra part to the scheme known as graduated retirement benefits. And this was the first kind of part of the state scheme that was designed to provide an earnings-related element in addition to that flat rate state pension. Now, this ran from 1961 to 1975, and in 1978 was replaced by something similar, designed to do a similar thing called SERPS. You might have heard it referred to as the State Earnings Related Pension Scheme. SERPS itself ran from 1978 and was then replaced by the State Second Pension. We love a good acronym in pensions, S2P, in 2002. And SERPS and S2P together are often referred to as the additional state pension. So you've got your basic part in those years, and then people would have perhaps built up an additional state pension. However, we are talking about employees when we come to these earnings-related top-ups. But then again, not all employees would have perhaps seen an additional state pension entitlement, even if they were and did reach state pension age under the old regime. This might have been because they were contracted out, okay? And we're going to talk about contracted out a bit later, but it's just one thing to bear in mind. So some employees would have built up an additional state pension, quite a substantial one in some cases. Other employees might have a smaller entitlement, and that's probably due to the fact that they were contracted out. Fast forward to 2016, and we saw the introduction of the new state pension and the current regime as we know it, okay? And This was a huge overhaul, really designed to kind of simplify the system, get rid of these additional elements, okay, bring to an end contracting out, and get back to what the state pension was designed to do, and provide that flat rate benefit, really as a safety net for people in older age. Just a quick recap on those additional pensions that we talked about, so our SERPs and S2P. Only those who reach state pension age before the 6th of April 2016 will ever actually receive an additional state pension or graduated retirement benefit. Those reaching state pension age under the new system, they won't receive that. They'll get the new state pension instead. But any element of additional state pension that they had built up under that old regime, so people who who've started taking or starting to be able to draw the state pension now, that's accrued and counts towards the calculation of comparing what they would have got under the old and the new regimes, and that comes in a later slide for us. Okay, so although they won't be receiving it, technically, it might still count when we look at what they might have received and compare it to what they get under the new regime. Okay, so moving again, or continuing to where we are in the current regime and state pension age. So the state pension age is currently age 66 for both men and women. It of course used to be the case that women receive the state pension at 60 and men at 65, but this was clearly viewed as being discriminatory for obvious reasons, and successive governments legislated to equalise the age. And the equalisation happened in 2018, at which point the state pension age for men and women then slowly increased to age 66 by 2020. So here we are currently at age 66. But as we know, it's rising to age 67 by 2028. And as with that age increase to age 66, we'll see a transition between 2026 and 2028, where there will be some people who have a state pension age of between 66 and 67 to accommodate that. Okay. After that, the next increase is scheduled for between 2044 and 2046. However, the government's repeatedly stated that it wants to accelerate this move, so it happens 7 years earlier. So it's likely that it will happen between 2037 and 39. They can do that. The Pensions Act 2014 provides for a regular review of pension age, at least once every 5 years, I believe. So it is possible that the increase might be brought forward, and we might see further increases in the future. I think currently I would be due to receive my state pension in July 2054 at age 68, but like I say, we might see further changes before then. I've popped a point on there about the NMPA, so the normal minimum pension age, and that's the age at which we can start drawing on our private company pension provision. Now, it's supposed to track 10 years below state pension age, and we're obviously in the middle of the pension bill going, the finance bill, I should say, going through Parliament to become the Finance Act, which is looking to enact legislation to increase the normal minimum pension age to age 57 by 2028. Now, our view, well publicised on that legislation, that it's a lot messier perhaps than it needs to be. So, we've been pointing out, we've got a keen interest in the fact that, yes, we understand why the NMPA needs to increase, but the way it's been provided for is too complicated. And obviously this is relevant to state pension, because if we're going to see a further rise in the state pension age to age 68, we want to ensure that any change then is nowhere near as messy as what has been proposed. So kind of watch this space on that one. And, like I say, it's supposed to track, the NMPA is supposed to track 10 years below the state pension age. Okay, moving on to the new state pension itself. Although he wasn't actually Minister for Pensions when it first started to be paid, it feels appropriate here to have a nod to Sir Steve Webb. He was the main architect of the flat rate system, the legislation needed to bring it into force, and also the transitional measures in his time as Minister minister. So identifying some of the issues we'll talk about actually in the next slide. So as I covered before, it was decided, that the state pension system was too complicated with different add-ons, contracting out. And so for those who reached state pension age on or after the 6th of April 2016, a reformed system was introduced. So rather than having those two tiers of state pension, a basic and an additional, people build up entitlements to a flat rate. So kind of really getting back to what state pension was designed to do, kind of in theory what policymakers wanted of a state pension benefit regime. In 2021-22, the maximum rate is £179.60 per week, and depending on your maths, works out at just over £9,370 per year. It increases with something known as triple lock, and again, more on that later. We'll cover that in a bit more depth. And the system really is going back to being a flat rate, and it's designed to be based on individual entitlements and people building up their own entitlements using their own national insurance record rather than reliance on spouses and civil partners records that was a feature of the older regime and obviously made things more complicated. In terms of what record you need to get that full flat rate payments, you need 35 years qualifying years of national insurance contributions. So that's 35 to get that full rate. You need at least 10 to get something under the system. So 10-year qualifying record to get anything under this reformed system. And credits are available for missed years, okay? So some people may have not been able to pay national insurance contributions for whatever reason. Perhaps they were unemployed and claiming certain benefits, caring for people. So there's a full list there of that link in terms of who can claim credits. And we'll look at gap years and missing years later in today's session. Those who had built up state pension entitlements under the old regime and hadn't reached their state pension age before the 6th of April 16, they will have a comparison, and we'll talk about that in a second, that's assessed against this flat rate or what they've got under the new system, okay? So we will talk about that in the next slide. State pension, just wanted to mention here, it's paid gross, but it's not necessarily tax-free. Of course, the money is paid gross, so without tax being deducted, but if clients have income, including the state pension, greater than their personal allowance, there is a tax due on the state pension, and this would normally be deducted from any other private pension provision that's paying out, or any earnings if someone is still earning through PAYE. Okay, so on to those transitional issues. The new state pension is easy for us to understand for people who start their working life now or started in 2016. But what about people who built up most of their record, most of their working years and working life under the old regime? We do like protection regimes in pensions after all. And the challenge when you're designing any new system, and Steve was quite vocal about this at the time, is that if you just move to that new system overnight and kind of discounted people's records under the old system or what they'd perhaps built up, in terms of years and credits, that could have seemed very unfair to particular groups of people. So it was recognised that there was a need for a transitional period that looked at perhaps protecting rights and credits already built up under the old system and old calculations, but also meant that most people got moved to the new system and a flat rate amount as soon as possible. So the first kind of group I want to look at are these people who built up almost all of their record, if you like, under the old regime, but actually weren't able to claim state pension until after the 6th of April 16. So to kind of look at whether or not someone receives any kind of transitional protection, the system looks at what state pension someone might have been entitled to under the old regime and compares that to the new flat rate under the new regime. So that old entitlement itself is valued by working out something known as a foundational starting amount, as you'll see here. And this foundational starting amount that's then compared to the new state pension itself is the higher of the amount due under the old rules, or the amount if the new state pension regime had been in place since the start of that person's working life. Okay, important to say there is a deduction made for years of time contracted out. And again, it's quite an easy concept to kind of understand. So the idea is to make sure that people who perhaps built up a large kind of foundation amount under that old system that was more valuable perhaps than the full new state pension would not completely lose out. Probably a good time here to kind of have a quick recap on contracting out. So contracting out was an option previously open to people whereby in exchange for lower national insurance payments, employees could agree to opt out of the additional state pension, so our SERPs and S2P there, meaning they would not build up an entitlement to it. Okay, so contracting out affects your additional state pension entitlement. Still relevant at the moment, as I say, because even those reaching state pension age now under the new regime, any years contracted out will be deducted from this foundation or starting amount calculation. Okay, so contracting out was definitely a feature of a lot of defined benefit schemes. Employees were often contracted out, so the idea is that their additional state pension entitlement that they don't get from the government is kind of built up within their private workplace pension scheme. So in terms of that foundation amount, what happens once you've worked it out? So the foundation amount itself is the higher of two calculations. Once you've got that, you then compare it to whether or not that foundation amount for the client is higher or lower than the full state pension. Probably easier if we track along the bottom of the flow chart here. So if that foundation amount turns out to be lower than the new full state pension at that flat rate, so £179.60 per week, if it's lower, that client could potentially build up some more qualifying years. Okay, they could build up more qualifying years to get to their 35 years and that full flat rate amount. If we follow the flowchart along the top line, so that foundation amount that's being calculated is actually higher than the new full state pension, they would receive the full new state pension, and that would increase with the triple log, but they would also receive the excess as what's known as a protected payment. Okay, so that foundation amount will contain the full new state pension and an excess amount known as protected payment. Okay, worth mentioning, obviously the new state pension itself increases with the triple lock, but that protected payment, if they are due in excess, that increases just with CPI. As we'll come on to for this year, that would mean that they increase at the same rate, but you could potentially see an element of someone's state pension payment increasing at a faster rate than the other. Okay, they of course, if their entitlement or the foundation amount, I should say, was higher than the full new state pension, they will not be able to build up more qualifying years or get a higher amount because they're already going to get the full new state pension and this protected payment. Okay. So that covers that kind of first bigger group, if you like, who might have a foundation amount higher than the new full state pension. But there's other transitional issues that we need to consider, and other groups of people that I want to cover that you might encounter with clients. So although the new state pension system is based around the principle of individuals building up pensions in their own right, okay, on your own record, in many couples at the moment, there'll be one partner who started to draw their state pension age in the old regime, and perhaps another who hasn't started to draw yet, or reached state pension age, or has reached state pension age, but under the new state pension regime. And why is this relevant? Well, because actually under the old system, it was possible to rely on your spouse's record, national insurance record in certain cases, either kind of on their death, in terms of inheriting perhaps an element of the state pension that they were receiving, or actually being able to claim on their national insurance record. So the first group I want to cover is those who might be able to inherit an element of state pension from their deceased spouse. So it depends on whether the deceased was drawing a pension under the old or the new regime. So if the former spouse had started to draw the pension under the new regime, the survivor might be able to still inherit a part of this if they were receiving any protected amount. So the surviving spouse could receive 50% of any protected amount that the deceased spouse was receiving. If someone dies and they were actually receiving SERPs under the old system, okay, so they had started to draw their state pension on or before the 5th of April 2016, and the survivor was under the new regime, it is possible for an element of at least 50% of that SERPs payment to be payable to the survivor spouse, even if that surviving spouse receives their state pension under the new regime. Okay. The kind of final group I want to cover are women who were paying lower rates of national insurance, but not through contracting out. So until 1978, married women were able to opt out of paying a reduced rate of national insurance contributions in return for sacrificing their right to build up a state pension in their own right for any years that they were on this reduced rate. This was often known colloquially as the married women's stamp. So what would happen is a woman paying the reduced stamp or paying the married women's stamp could claim a state pension based on their husband's record of contributions. It sort of feels quite old-fashioned now, but if you think about it at the time, this was kind of in the post-war era, and obviously society and things have changed quite considerably since then. So although the ability to opt to do this for the first time for new cases stopped in 1978, those women who were already on the reduced rate were allowed to continue to do this past 1978. So obviously numbers are sort of dwindling now, but there was still a large number of women who'd done this. And, you know, had done it in anticipation of being able to draw a pension based on their husband's record of contributions when it came to it. So obviously when the new regime came in and it was based on individual entitlements, these women had perhaps not built up records in their own right because they were relying on married women's stamp provision. So there was a concession introduced which allows women to draw a pension at a rate of 60% of the old basic state pension rate, provided they were still paying the married women's stamp at some point in the lead up to their state pension age. Okay, so there is some provision there for anyone who might be affected by that. Okay, so moving on to the triple lock, so the rates of increase of this new state pension. This is provided for in the Social Security Uprating of Benefits Act, and that Act for 2021 has now since passed achieved royal assent, despite calls from the House of Lords for amendments. So you might have seen that recently in the press about the Lords proposed some amendments, but the legislation has now passed. And this, for this year, is relevant because it confirms that the government is actually dropping part of this triple lock. So if you like, it's becoming a double lock for 2022-23. We'll cover those circumstances in a second. So pensions are increased in April of each year. Under the triple lock, that would ordinarily be the highest of the average earnings increase for the previous year, CPI inflation, the annual rate till September in the previous year, or a 2.5% underpin. So if both of those initial amounts are less than 2.5%, that underpin will kick in. And that's actually what happened for payments being made this year. Obviously, with the circumstances of the pandemic, the rate of change in prices and earnings, both were below 2.5%. Earnings were actually negative, so that triple lock did come into force. Pensioners in receipt of their state pension did see it increase by at least 2.5%. Now, forward to the increase for next year that has been decided upon. So for 2022 and 23, the pensions will increase by the CPI rate of 3.1%. Now, the earnings figure calculated under the kind of methodology would have been 8.3%, and the government felt that perhaps that earnings figure is kind of unfairly skewed for this purpose by the return from people from the coronavirus job retention scheme furlough. That has kind of affected and bumped up earnings that would obviously fallen in the previous year, and the government feels that perhaps the earnings increase was perhaps overstated, and it would not necessarily be appropriate to use the triple lock just for this year. So the full new state pension from the 11th of April 2022 under the CPI increase is going to be £185.15 per week. And the government has said that the triple lock will be returned to being a triple lock from next year, coincidentally when the new health and social care levy is introduced. Quick word on frozen pensions, actually. Just wanted to cover this, it's kind of relevant for the triple lock. So if somebody had moved to a country in the EEA, the European Economic Area, or the US, or a list of other countries, includes places like Israel and Mauritius, I believe, your state pension will increase once it's in payment. Okay, so even if you aren't a UK resident anymore, your state pension will increase. However, there are over 100 countries worldwide where the UK basic state pension is not uprated each year. Okay, and that includes some places that are quite popular with people retiring to, so Canada, Australia, New Zealand. So that's when you hear the phrase frozen pensions, it relates to whether or not someone's able to actually obtain an increase in their state pension in payment. And if you think about life expectancy, the state pension age, over time, this could obviously, with inflation, depending on where you live and the cost of living, that could significantly perhaps erode the purchasing power of your state pension over time if you are one of these people who draws a frozen state pension, if you like. So moving to state pension forecasts. So these can be accessed on the online system by telephone or using a BR19 paper form. In terms of the online system, clients are able to access this using Government Gateway if they've used that before for self-assessment perhaps, or any kind of other pension protection that you register for online. That's normally accessed by Government Gateway, or there is a Government Verify system, I believe. So what does a state pension forecast show? And I've taken this image from Henry Tapper's Age Wage blog of a state pension forecast, so thanks to him. It will tell you your state pension age. So you'll see on this forecast that it's the 11th of November 28. It will also contain information on qualifying years, any part or gap years will be highlighted, and it will show a kind of current value and an estimated future value of your state pension. It might tell you whether you need to continue contributing to reach the forecasted amount. As you'll see here, it's this amount is under the current maximum amount under the new system. Okay, so it obviously relies on all the government systems from HMRC, DWP, other agencies all talking to each other, but there is a whole host of information on there. And, you know, it's likely perhaps that you are helping your clients get a forecast if you're inputting into your forecasting, cash flow, whatever you use. So it's good to kind of be armed with what it might look like, as well as obviously for ourselves. Now, kind of a question I sort of anticipated was, in terms of a forecast, is something that's shown on there called the contracted out pension equivalent, or COPE. Now, this can sometimes throw people, and I'm guessing it might throw quite a few questions your way from clients. So it's an estimated amount that's included on the state pension forecast to kind of reflect for the time that a client was contracted out. So we talked about contracting out earlier, where somebody paid a lower rate of national insurance on the understanding that they would not build up an entitlement to the additional state pension under the old regime, so your sort of SERPs and S2P. Now, a COPE amount is an estimate of the amount that will be included in that other pension, so your DB pension or your personal pension pot as a result of being contracted out. Okay, so it is shown on the online forecast system. It is shown if you use a paper form, but it's already accounted for in the green box in the amount that you're forecast to get. It's not an additional amount that you need to take off, or you need to take off from the client's forecast if you're inputting into cash flow. And again, equivalently, it's not something that you need to add in, as the idea is that it's provided for within either the equivalent defined benefit scheme or appropriate personal pension. It might be best understood if we think about it in the context of final salary schemes, so company pensions that promises to deliver X pounds per week, and it should reflect the lower additional state pension entitlement, okay, and it should be adjusted to reflect that. And with a final salary scheme, it's likely that the COPE and the sort of additional amount that they might receive through the final salary scheme are roughly equivalent. But the idea about this COPE amount is that a client might wonder why they're not due to receive the full new state pension, and the COPE element should sort of help understand that. It's a little bit harder to perhaps explain and understand in relation to money purchase pots, okay? So in terms of personal pensions, if you were contracted out, you paid a lower rate of national insurance, and then your pension scheme received a rebate. So actually the net effect is that you paid lower national insurance, but there was a rebate paid into your pension scheme. Now, the way the rebates were calculated is that they were designed to kind of, obviously replicate the entitlement to the additional state pension, but the rates that were used at the time and the way things have changed over time has meant that the amount someone might have built up in a personal pension through contracting out isn't going to necessarily produce this contracted out pension equivalent, okay, based on a whole host of different factors, of course, because the personal pension will be subject to investment growth or loss over time. Then you're looking at what annuity rates you can secure with that personal pension to kind of replicate the contracted out equivalent. So it's quite likely the assumptions at the time mean that somebody who contracted out via personal pension might not kind of be able to replicate quite the same amount as the COPE element would indicate on their forecast. Okay, so it's sort of designed to be helpful, but it could also raise a number of questions, I guess, between the clients and yourselves. So the main things to remember is it's already been deducted from the forecast. It isn't guaranteed. It doesn't mean that somebody contracted out is automatically going to get this COPE amount elsewhere from their private pension provision. And like I say, it's not guaranteed. It shouldn't be added in or deducted from what you perhaps are inputting into your client's cash flow. Okay. So moving on to missing years or gap years in records. So clients might have gap years in their record or part years, and this will be highlighted in their forecast. What do you want to do if you want to kind of fill the gap? So firstly, the first thing to do in the event of any kind of gaps is check whether the client's able to claim credits for those gap years. So as we mentioned before, clients might be eligible if they were claiming certain benefits or unemployed or were a full-time carer for any sort of time in their working life. So they may not have paid national insurance or at the rate to get a full qualifying year, but they might be able to get credit as if they had for certain reasons. If that's not possible, however, and your forecast indicates that you might receive less than the full state pension, you may still be able to top that up by paying voluntary contributions, so voluntary national insurance contributions. And a wide range of people can do this. Those in employment can pay class 3 national insurance contributions, and the self-employed can usually use class 2 contributions to plug any gaps. So those who've reached state pension age and see that they've got a gap in their record or are about to reach state pension age, they can do that via class 3 contributions. And it is actually possible for those living abroad to also do the same via class 2 or class 3, depending on their circumstances. So, people might want to do this. So they're close to state pension age, they don't have enough qualifying years, so 35 years under the new regime. You might know that you are not going to be able to get 35 years, depending on your circumstances during your working life. And you could be self-employed, and for whatever reason, your profits mean that for a year, you are not going to actually pay or have to pay class 2 contributions. So you could choose to make voluntary contributions depending on your circumstances. So you can normally pay towards the last 6 years of your record by the 5th of April. So if you wanted to plug a gap or a missing year for the year 2015-16, you have until the 5th of April 2022. Pensioners have 6 years after they reach state pension age to increase their state pension by making voluntary contributions. And it's well worth investigating because class 2 contributions can be, in certain circumstances, particularly with clients, very good value for money. There is an ability to pay, I believe, for more than 6 years, depending on your age as well. So again, if there's gaps, missing years identified on a record, it's well worth investigating. So the cost itself obviously depends on when the gap occurred. So if we're looking at 2021-22, for example, the cost for a full year, so kind of filling that full year, if there was nothing there, would be just over £800 for the full year. This would give you an extra £5.13 per week state pension based on the current rules. And if you actually lived 20 years from state pension age, that could be worth over £5,000. So £5,000 in exchange for that £800 top up. That's looking over a 500% return. So it's well worth investigating. I've seen lots of instances of advisors doing this with their clients and, kind of being very happy with the result. And it's a great way to kind of show some added value as well. Okay. So hopefully that covers everything sort of missing and gap years. So that's the gap years towards the new state pension there. Quick final word on deferring. Now, this used to also, along with plugging sort of missed years with voluntary contributions, national insurance contribution, be a popular option, but has certainly become less popular, perhaps less good value, should we say, under the new regime. A quick word actually, yes, to say that those who started state pension before the new regime came out can pause their payments. Otherwise, if you just leave things as they are, obviously your payments will continue to increase. And the value of deferral for somebody kind of depends on their health and the rate of income tax they pay. So as we mentioned, state pension doesn't suffer a tax deduction on the amount you receive, but it is potentially taxable depending on other rates of income. So if you had somebody who was paying, for whatever reason, 45% income tax, but the expectation was that they had many years to go through past state pension age, you might look at deferring, but like I say, it's now kind of considered far poorer value than it used to be. And one of the main reasons for that is there's no lump sum option with deferrals. So under the old basic state pension, you could choose to defer in exchange for a lump sum further down the line, and the calculation could prove good value if thinking about your health and income tax rate. Now, not so much. So now, if you deferred your state pension for a whole year, so 52 weeks, you would then get an extra top up on your weekly payments, and that would be an extra £10.42. And it works out kind of just under 5.8% of the current maximum flat rate pension. So the payback period, if you were to defer for a whole year, it would take you around 17 years to kind of claw back the value of that pension deferred. So it doesn't seem as good value for the majority of people. Very important final point I put it in deferral here, but I don't know, perhaps we should have put it in the new state pension side. But if your clients do not claim their state pension, they will automatically be deferred. Okay, so it's really worth an extra reminder to say, you know, this doesn't automatically start paying out when you reach state pension age. You really do need to put in your claim. What tends to happen is clients will get a letter a few months before they are due to reach state pension age, and they'll be invited to use a code to apply online and answer a few questions about kind of their working life, also their kind of marital history or history of civil partners, in terms of whether they worked abroad and things like that. So a few questions, quite simple, and you get like a code. You can also go on and look at the government gateway system as well. So that's kind of covered the content I wanted to go through today on state pensions. And I just wanted to kind of finish on a slide of discussion points, really, just kind of when I was thinking about the session, what I thought might be relevant to clients with advisors, and what kind of might be coming up at your discussions at your review meetings, for instance. So I guess the main one for me is I would ask you, do clients understand the value of state pension? So if you try to sort of reverse engineer, so a full new state pension, you try to replicate it via an annuity, so you've got the escalation there. You know, indications are that it would be approaching a kind of pension pot value of £300,000 there for somebody at age 66. So, you know, I don't know if that changes things when you're having those conversations with clients, if they think about how valuable it might be. Obviously, if you've got significant other provision in terms of other assets, other pension funds as well, it can be perhaps quite easy to just say, oh yeah, state pension, whatever, but there it's kind of in black and white. And I guess in my mind, it kind of underpins that kind of later life cash flow as another kind of tap to turn on once they reach state pension age. Obviously, on the flip side, in terms of later life and long-term care, a state pension is hardly going to sort of fund long-term care provision. So although we talk about it as a safety net in retirement, obviously the picture's perhaps different for clients with advisors. Again, the new simpler system, although it's a lot easier to understand, it's going to take a few years to fully embed. We're still going to have those questions about kind of forecast, contracting out, where we are with things. Obviously, in the workplace pension space, there's work to be done there as well. And just, yeah, my kind of last observation, I guess, when I was thinking about this is, you know, advisors are well placed to be able to help with forecasts, claims, just even knowing that you need to claim it is sometimes overlooked. Considering top-ups, whether voluntary contributions are a good idea, obviously helping in terms of any credits that might be able to be claimed and other complexities with the system. So that brings me to the end of today's presentation. Thank you so much for watching our webinar. Please do let us know of any questions that you have on the feedback form. Like you say, any new topics you want us to cover. I'd probably say a quick word for those of you guys who are maybe not aware, on our info centre, on the Invest Centre website, and there is an info centre there, and it contains our previous webinars, so myself and my colleagues Lisa and Rachel, and also advisor guides that we might have produced alongside some of those more technical pensions topics. So yeah, do let us know what you think, whether you'd like us to cover any additional topics, and that just leaves me to say goodbye and thank you.